We didn't learn anything. Billionaire investor Stanley Druckenmiller says the next financial crisis could be worse than the last and lays out how it might happen. Who formerly managed money for George Soros ran his own hedge fund and now oversees a family office, says conditions are ripe for a financial crisis that could put the last one to shame. In his mind, they have infected financial markets and led to exorbitant pocket of debt all around the world. More than anything, he is worried about the reckoning that's bound to transpire as global central bank make borrowing more expensive. The former lead manager of George Soros' quantum fund, Druckenmiller, last oversaw 12 billion as chairman and president of the Queen's Capital Management. He now manages his own wealth as a family office. The crux of Druckenmiller argument is that after a decade of easy lending, investors worldwide will be shaken to their core by tighter monetary conditions. Once the endless supply of cheap money that flooded global markets start to dry up, all bets will be off and a market collapse will be in order. With the monetary tightening, we are kind of at that stage of the cycle where bombs are going off. My assumption is one of these hikes, I don't know which one is going to trigger this thing. Ultimately, this toxic combination of factors could end up generating a global meltdown that puts the one from a decade ago to shame. After all, the last instance was driven by excessive risk taking and unsustainable amount of leverage. And wouldn't you know it, uh, eerily similar circumstances exist now. Intuitively, you can make a case that we are going to have a financial crisis bigger than the last one because all they did was triple down on what, in my opinion, caused it. He said, "We seem to learn something from every crisis, and this one we didn't learn anything." If you are considering brushing off Druckenmiller's warning, consider his nearly unparalleled parallel track record over the past 30 years. During that period, he earned 30% compounded annual returns and never experienced a down year. In 120 quarters, he's only been down in 5 of them. I have a bearish bias and kind of had the scenario that the first half would be fine, but then by July, August, you'd start to discount the shrinking of the balance sheet. I I just didn't see how the rate of change would not be a challenge for equities other than PEs, and that's because margin are all at an all-time record. We have at the top of the valuation on my measures to look except against interest rates, and at least for 2 or 3 months I have been dead wrong. These algos have taken all the rhythm out of the market and have become extremely confusing to me. And what do you take away? Price action versus news from someone who has used price action news as the major disciplinary tool for 35 years. Tough. It's become very tough. I don't know where it's all going. A lot of these algos apparently are based on standard deviation models, so just when you would think you're supposed to pile on and lift off, their model must tell them because you're three standard deviations from what you're supposed to be. They come in with these massive programs that go against the beginning of the trends. I would raise rates every meeting as long as I could, and the minute you got substantial disruption, I would back off. We have this massive death problem. If we don't normalize, it's going to accelerate and cause a bigger problem down the road. If we do normalize, we are going to have a problem, and unfortunately, we are going to have a much bigger problem than we would have if we have normalized 4 or 5 years ago. His philosophy on making large concentrated bets as the disclaimer, if you are going to make a bet like that, it has to be in a very liquid market, even better if it's a liquid market that trades 24 hours a day, so most of those bets for me invariably would end up being in the bond and currency markets because I could change my mind. I like to buy not in the zeros innings and maybe not in the first inning, but no later than the second inning. I don't really want to pile on in the third or fourth or fifth inning. One of my most important jobs as a money manager was to understand whether I was hot or cold. Life goes in streaks, and life and like a hitter in basketball, sometimes a money manager is seeing the ball, and sometimes they're not. In my opinion, when you're cold, you could be trying for bunts. You shouldn't be swinging for the fences. You have got to get back into a rhythm. That's pretty much how I operated. If I was down, I had not earned the right to play big. Probably the most destructive thing Trump has done in the global trading system is figure out how powerful a weapon the US banking system is and how powerful sanctions are. Yes, you should use this weapon once in a while, but when you start just shooting it all over the place and you are now shooting it at Canada, at Europe, here or there, that's not a lot different than shooting at Iran or Russia. He's like a little kid that found his this water gun and he's just running around going all over the place with it. And the biggest danger I see is we lose that trust that America is good.